again, and welcome. This is Robert Schein, Managing Director and Partner at Blanke Schein Wealth Management. Thank you for joining us for our market insights and observations. Today is Tuesday, May 30th, and I trust everyone had a wonderful, restful, and honoring our Memorial Day, all of our veterans. And thank you for everything that you've done for our country, past, present, and future. Let's get right to our updates of the day. Well, we have the debt ceiling deal. At least in principle. Now there's procedural votes that have to take place. We're also going to talk about the U.S. economy, an update from Strategis, and we'll go through sort of the 14 aspects that's on their radar, our radar as well, as well as the real estate home prices. There's a Case-Shiller index that was just reported, and it shows that there's some change there in our home prices in the It's probably a direction you wouldn't think based upon all the economic information. But let's get to the Strategis Economic Balance Sheet, basically index. And so if you don't know that Strategis is a third party that we use here at Blanke Schein Wealth Management, and some of their research is second to none. They're consistently in the top 5 every single year in terms of an independent research firm. With regards to the economy, markets, both quantitative and qualitative as well. But today we're going to tune in and highlight their most recent report. And they look at the U.S. economy in 14 different buckets, if you will. We're going to go through like about 9 slides today. And they categorize the economy in asset, a liability, or as well as a neutral. So basically a positive, a negative, and sort of somewhere in between that's really not going to weigh on the economy one way or another too much. So let's go through this. The Strategis balance sheet is showing that there is a positive uptick with regards to some of the key economic data points that they follow. Now, let's look at what they follow. Under the assets category, or the positive to the U.S. economy, we have CapEx, and that's capital expenditures. Corporations using their extra cash on the balance sheets to reinvest or redeploy outside just dividends, if you will. So it's a positive because that spending in the economy also helps sort of the GDP. And that means that corporations are healthy, they have cash, and their debt is well in hand. And so right now, as we look at corporate America, and the U.S. economy, the CapEx is in the asset category. Employment, right? If we look at the employment picture right now, we know that the U.S. economy is, if you need a job, want a job, looking for a job, it's well in hand right now and well within reach. And then the consumer spending, that's another indication in the asset category. And we'll go more into that in just a minute. Under the neutral category, so it's not leaning more of a positive for the economy or even a negative at this moment in time, is the trade deficit. We also have non-residential construction. The government deficit, right now, obviously we're getting some resolution on that, at least in the short term, maybe 2025-ish, depending upon, I think they kicked it past ultimately the 2024 election, and that was politically smart on both sides. Obviously, Strategy was involved there. But here's a big change right now. We're going to talk about it at the end, which housing went from a liability now into the neutral category. So it went from the negative to not positive, but not negative either, sort of just in the middle. And we're going to show you that as well. Now, under the liabilities, you've got all the inflation, right? You have price inflation, everything that you and I spend money on. It's expensive. The wage inflation is essentially what the Federal Reserve is paying closely attention to. Business confidence, consumer confidence, the credit environment, interest rate environment, and then manufacturing. Those are all sort of weighing down on the economy. So each month, again, they categorize the 14 broad U.S. sectors, and ultimately it's the real activity with prices, assets, and liabilities. And this is just showing that the key support for the U.S. economy right now remains the labor market, consumer spending, and CapEx. And those are huge. Remember, 2/3 of the U.S. economy is the consumer, right? And that's forcing the GDP. And then you layer in corporation spending. Now, what you're not going to get more austerity that we're going to see from the debt ceiling is from pulling back or slowing down in terms of government spending. But there's signs that there are cracks forming and that there's some slack in the economy for the Fed to pay attention to. And that's important because essentially for the June meeting, does the Fed pause and just basically stay higher for longer? Do they raise rates? Now, if we look at the Fed funds futures, there's a 56% chance right now, as we record today, that there's a potential that the Federal Reserve raises once again, one more. Again, as we know, even the day before the Fed meeting, minute by minute, hour by hour, that could change. And the Federal Reserve often, even most recently, even within sort of behind closed doors, there's sort of a difference of opinion versus everyone used to be unanimous. There's more language out there. We had a lot of Fed speak over the last few weeks, ultimately saying there could be setting up for a pause. But again, we won't know until that happens. But they're monitoring ultimately the economy very closely, as they should be. Things are already breaking in the U.S. economy, i.e. the banks. Remember when I said, if you followed along for quite some time, Federal Reserve raises rates until something breaks in the economy. They're trying to slow down. Well, that's going to have a knock-on effect. Basically, the banks expect it to tighten. So that's another sort of quiver or a ancillary effect that's going to play out for the Federal Reserve to slowing the U.S. economy. And ultimately, it's basically just edging the Fed closer to maybe pausing and seeing the cumulative effect of the 10 rate hikes potentially to basically just hang out and see what's happening. So let's go back to the price inflation. Right now, currently, it's a liability, as we talked about, according to the strategist report. But the good news is that this is a key component to what the Federal Reserve is really looking for, is the inflationary report. So the CPI and the core PCE, both of those, well, the PCE sort of ticked up a little bit last week, but the trend hopefully is in this direction on the way down, which will help moving forward. Business confidence. Business confidence has come down year to date. One, from the lending standards and the small business optimism. Clearly, small businesses utilize a lot of small regional banks for lending. Small regional banks are now basically hunkered down, protecting their balance sheets, so they're not proactively looking for lending. Well, that's going to impact the small business owner, and that's going to cause the small business owner to say, listen, I'm not going to spend extra money that I may not have based upon any sort of revolving credit that I could get or future credit. And then maybe we're going to not grow. We're just going to hang out based upon the economy and not add to an employee or head count right now. And let's just see what we can do. And ultimately, also what you saw is leading up months to the debt ceiling debate that we just saw, the confidence as well as for the CEO confidence has declined. But that CEO confidence actually spiked up most recently, which is, while it's still on a trend down, at least in 1 month uptick doesn't make a long-term trend. At least we could see the CEO's business roundtable sort of pause, if you will, in terms of that downtrend. Now, if we go to liability, again, under that category, the credit environment. So basically the consumer credit year over year, as well as credits, or the fixed income spreads. Now, fixed income spreads haven't essentially what we call in our industry, if the fixed income sort of yields on fixed income for corporate Americas and ultimately the BAA corporate, if it starts spiking up, that's a concern. That's where we start seeing more of the U.S. sort of stress in the economy as well as in the markets, the equity markets. Right now, it seems contained. In 2000, and obviously in 2008, 2009, you see what we call the spreads blow out relative to treasuries. And right now, they're seemed well contained, and that's a very key indicator, as well as consumer credit year over year has obviously increased, and it's downticked right now. So the credit market is important, as well as credit card borrowing has surged, and that's just maybe showing signs of constraint on the consumer. The interest rate environment right now, we all know this is a liability. We just spoke to this. The 10-year Treasury yield as well as the Fed funds yields are up, so that's putting pressure on, like, let's say, housing and a few others, consumer debt as well. CapEx expending. So here's what's interesting. This is private non-equipment investment. We've seen a spike up, and the trend has been up, but most recently a little stall here and there. U.S. manufacturing orders, X-aircraft is continuing to do extremely well, and that's the CapEx spending. Do our businesses, large businesses, reinvesting and growing? Here's what's in the neutral category is the consumer confidence. Ultimately, a little bit of a downtick leading up to the debt ceiling debate. That's not uncommon. And consumer sentiment is down. And consumer sentiment basically is tracking a 6-month low right now. So this could move to the negative category if we want to. We have to keep a close eye on the University of Michigan consumer sentiment. Consumer spending, again, is still tracking on goods and services. Goods and services. Services is getting back to sort of the break-even line, and the goods is well above. So everything was the stay-at-home that was basically hit by the supply chain. Sort of think about, like, if you had your Peloton bike or something that you needed, say hardware, computer stuff when we were all at home during COVID. Well, we saw that spike. Now we're seeing the services, like the travel we just saw. 42 million Americans just traveled over this Memorial Day weekend, and that was the most that we've seen since 2000, breaking records again. And so that's why we're seeing airfare, we're seeing hotels, and a lot of this, and there's tightness in that labor market. Everything's costing more in that area because it's just trying to get back to the break-even line. But people are still traveling, and services are still stronger than ever. Housing, here's what's interesting. We're going to go to the housing in a minute. U.S. housing activity has been hit by interest rates, which is, obviously not a surprise, and it's reducing the affordability. But a reprieve in rates has led to some small boost in recent months to housing. But obviously, most recent is Friday, we saw mortgage rates hit 7% again. So then this is backward-looking data. But we put the sector in neutral in our balance sheet this month because of the mixed data. The U.S. housing sales, as well as home sales, the U.S. single-unit home sales has ticked up. Okay, and that's a trend that means New York Post reported that new home sales jumped 13-month high in April, even while prices are dropping. So as we said, if you look at all sectors of the economy, there's a diversification built in for the U.S. economy, and that's what's keeping us sort of moving along. But there's also, with regards to real estate, there's different pockets. Like if you look at the New York to San Francisco markets, those are down, if you will. But if you go to, let's say, Florida and Texas and a few other areas, those are up in terms of home prices. So that diversification. And as we know, real estate's all about location, location, location. So we're seeing that. But here's what's interesting. We have the home prices declines may be over. According to Case Shiller, the national home prices in March were up 0.7% higher than year over year. And also, seasonally adjusted rates nationally are up 0.4%. Again, I said the diversification depending upon the 10 cities that they're looking at, but the composite is rising. So that means that the lower lows, the cities that I talked about, could be stabilizing, and the higher highs, those cities and states that are sort of hot right now, are sort of help stabilizing sort of the home prices in the marketplace. So that's our update right now. One sort of shout out right now, if you're following along in the Coachella Valley, you know that we have a new hockey team called the Coachella Valley Firebirds, and they have set the desert on fire in a positive way. They keep winning. They won the Pacific Division, and that's very exciting. We were there for the game last week, and now they are in the Western Division Finals. And guess who they're playing? All of our friends in Milwaukee. In fact, they lost the game yesterday, Game 3 to Milwaukee. So it's now a 2-1 for the Firebirds to Milwaukee. So all of our friends, Don Stockhausen and everyone in Milwaukee, I'm sure you're following along. That's sort of our competitive connection right now that we have in the heat of the summer. And good luck on the next game, and it's going to be fun. These are fun games to watch, and we're having a wonderful time paying attention and following along here. So that's our update for today. Thanks. Don't forget to like and subscribe and share with friends and family. We'll see you again next time.